Hello, everybody. Are you tired of the 401k going up and down and your portfolio bouncing around like a yo-yo, looking at all those losses? I have a lot of people that have been asking to invest or what is this investing about and what am I doing? And I'm going to put together this quick video. Try not to go into the weeds with it really quickly on what I'm doing. Number one, I invest in multifamily apartment communities. This is not duplexes, this is not triplexes, this is not quads, this is not eightplexes. This is big apartment communities in great locations. That's number one. I don't ever sacrifice the location. You can paint the building, you can update the units, but you can't change the location. Location is number one. I always look for the best locations and the best products that are going to perform in those locations as well. So let me tell you really quickly of what I look at so that you get a good idea of like what the type of things are. I've been looking at this 5 portfolio property in St. Petersburg. You can see it's 114 units here and it's 5 properties. This is the offering memorandum. It talks about what's going on here. 114 units, average rent is 275. So I look at all these offering memorandums and I could see where they are in the map, and I go and I drive the properties and I make sure that if it's location, if it's good, then okay. And then after I do all of that, then I figure out all the numbers to figure out if it's going to be a great investment that I can offer it up for people. And number one, if it's going to be a great investment for me, because if I'm managing this deal and if I am making sure that I'm going to earn some money on this deal, my money is actually in this deal, then I want to make sure that it's a good investment. Okay. So before I even offer it to you guys, if I'm not going to put any money into it and look at that property and manage that property, then I don't, for sure as hell, I'm not going to go and pitch it and make and say, hey, you guys got to invest in this thing. There's no way I'm going to do that. Okay, because I'm going to be part owner in this property. I'm going to actually have be the majority of the owner of this property and managing this property and making sure that I'm taking care of the tenants, taking care of all the repairs, the rehab, driving the rents, making sure all the value adds going on, managing the people that are on the property, managing the property. Okay, so you guys don't have to worry about this. So if I got to do this day to day, for sure, I want to make sure that this is a property that I want to be in. Okay, so with that said, let's go through some of these numbers because people ask me all the time. Number one, what is the initial hold or what's the duration? How much do I got to put in? All this stuff. Minimum investment is $100,000. You have to be accredited. Okay, I don't have the extra fund set up that we can take non-accredited investors because that costs a lot of money. All right, so minimum investment is $100,000, and also the whole period is minimum 5 years. Now, that doesn't mean that your money's tied up for 5 years. There's ways to get it out, but expect this money to be sitting here compounding as inflation is rising and as we're driving the property value up and up and up with all of these rehabs and executing the strategies to get this property to perform to the level that's supposed to perform at. It's going to take a couple years. So realize that this is not like a get rich quick. You're trading. We're not flipping here. We're building wealth. Building wealth takes time. These properties to rehab, 114 units there, takes time to rehab that. Here's another one here. I'll show you run really fast. Here is a really nice one I was looking at. It's in Sarasota. Beautiful property. Look at that. It's gorgeous. 358 units, value add investment property in Sarasota. Okay. Beautiful property. All right. It's value add, like they said. There's an execution strategy. There's a business strategy that goes along with this property. Beautiful. This thing is gorgeous, man. They have vinyl plank flooring, granite countertops, and there's a value add potential here. It shows you a number of units completed for the different things that they were using to renovate and how many remaining units and what needs to get renovated to bring it up to value. Okay. This is stuff, like I said, this stuff, you can't do it in a year. You can't do it in 6 months. It takes a couple years to go through 358 units. All right. So, like I said, $100,000 a minimum investment. Let's just do simple math. I'm not going to size up that deal. I've actually plugged in a different deal. And here's a quick formula, really fast, because although people always ask me is, How do you create double-digit rate of returns? Because the stock market's not even doing that. I'm going to show you right now. Okay, pay attention. Let's just say it's $15 million. This is a deal I was looking at. I think it was a St. Petersburg deal, somewhere around here. I'm not going to go through that, but just keep it real simple, really fast. Actually, you know what? I'm going to show you that deal because I think it's really important that you see this. Let's see. It's up here actually in my browser. I will find it. Here it is, right here. This one. Okay, this is St. Petersburg deal. Beautiful property. They rehabbed it. This one is 40 units. Okay, and actually they wanted $7.5 million for this property, which is pretty good actually, comparing comparing to what's already out there. So if you break down the math of 7.5 million divided by 40 is close to 200,000, I believe, if I remember correctly. 7.5. I'm just doing the math really quickly on my phone. Divided by 40 units, $187,000 per apartment. So that's roughly around the range per apartment for this area. Okay. So let's go back to my spreadsheet. Let me show you some quick math. Oh my God, how do I minimize this thing? Okay, how do I move this around? All right, I don't know. All right, let's go back to the spreadsheet up here. Just give me a quick second. Nope, that's not it. I got a lot of sheets open because I work on a lot of different things. All right, here we go. Move this down a little bit out of the way. My screen sharing. Okay, so this is just basic input, basic math. I'm not going to go too much into the weeds with this. I can, but I'm not going to because it's difficult to explain and wrap your head around it if you don't understand this. Like I said, the money is backed by multifamily real estate that cash flows from day one. Money gets put into escrow account, attorneys and accountants manage all of this. I don't touch your money, and it goes into these accounts and it gets managed and audited by third-party people. Okay, you are a limited partner on this transaction. I am a general partner. I'm the one signing on the deal. I'm the one who's qualifying for the deal. I'm the one who's vetting for the deal. They won't give you the money because they only give people who have experience and who are accredited investors and who have done multifamily apartment transactions, and I have. So a lot of people can't even qualify for these types of loans unless you flat out drop $7.5 million or $15 million to buy this property. Then you can buy it flat out. But who has $15 million laying around? Okay, only the super wealthy rich people. And I'll tell you what, they're not dropping $15 million on 40 units. They're making big plays. They're buying that Sarasota deal, which is 358 units, and that deal will probably transact over $100 million for that purchase of that apartment community. Okay, so wealthy people are making big purchases. They're buying big plays. They want to own territories. They don't want to just own a little piece of the territory. They want to own the territory because then they can control the market. You understand? And so let's just go really quickly about how this works. So $15 million right here on the spreadsheet is the purchase price. We have a 1% closing cost, and total investment is 15.2 million. Okay, we're going to put some financial inputs in here because we are taking a loan. We're going to use some leverage. Okay, so purchase price is 15 million. We're going to put a down payment of 30%, which is 4.5 million. That 4.5 million we're going to raise through investors. I'm going to be one of those investors that's going to be putting money into the deal. Like I said, I'm not buying something or advocating you invest into something if I don't have my own money in this deal, right? And so we're going to take a loan for $10.5 million. So now here's another calculation here that I actually calculated the annual loan payment on $10.5 million to $750,000. Okay, and then there's the principal balance of paying that loan payment over the course of 5 years. Like I said, this property is a 5-year minimum hold to be able to get the value extracted out of the property, rehab the property, drive the equity value up, which is called forced appreciation by doing rehabs and improving the property. So we're going to have to calculate what that balance is that we are paying out, so we can figure out what our rate of returns are. Year one here, year zero, it's 4.5 million. Okay, we put in. Year one, we cash flow. Cash flow is the gross collected rents minus the expenses minus the payment, the loan payment for the year. This is all based on the year. Okay, so if we go down here to the rental inputs of how I got to that number, okay, it is average rents of $1,200, 136 units. That's the monthly income. Multiply that by 12 to get the annual income. And then I took a 45% expense flat off the bat. It's going to be around 45%, 50% on the high end, 55% if it's really, really bad value add and you really got to do a lot of stuff. But usually it's around 45% and it was your expense ratio. And then so you have a net income of just over $1 million. Okay. And that's how I got year one cash flow. Okay, so if we look at that, I'll just highlight the field so you can see the calculations. It's A20 minus A11. A20 is the net income minus the annual loan payment is your net cash flow. Year one. Year two, same thing. Year three, same thing. Year four, same thing. These are not accurate numbers because obviously we're going to be doing rehabs. We're going to be driving the income up. We're going to be managing the property. We're going to be improving the operations and doing a lot of value adds to increase the value of the property. And we also get inflation, which I didn't account to here, which is an inflation rate of 3.5 or 4 or 5%, which we know it's a lie. We know it's a lot more than that, but we'll be conservative at 3.5 or 5% inflation. Okay, but for just simple purposes, I kept the numbers the same. Okay, but just keep that in the back of your mind that these numbers are going to be increasing over the course of the year as we're in this investment together. This is the total that we hold for 5 years. And then we get to the point that we finish executing, we drove the value up, we got the property to where we were at or where we projected to be at. And now we came back and we said, okay, we did our calculations and we said, okay, the sale price, we're going to sell it at $20 million to exit out this deal. $20 million is we're going to put it up for sale. We get the sale for $20 million. Again, this is all numbers that are very high, very carefully calculated. $20 million. If you must know, it is your net operating income divided by your cap rate for the property. Cap rates and different classes of properties all vary. You have A, B, C, D class properties. Cap rates all attached to the different classes of properties, and all of that is different based on which area of the United States you're in, which city that you're in, which area that you're in the city, okay, and which class of property that you are in that city. You understand what I'm saying? So there's a range. But let's just say, for example, it's $20 million that we're going to sell this property for. Our loan balance is $6.7 million, right? And that's minus the principal pay down of 5 years of 3.7 million. So our proceeds, our sales proceeds, after we sell the property, we pay our loan balance off, we have $3.2 million left over for us. Okay. What does that mean? From this point on, we do a 70-30 split with everybody, right straight through the band. Right, we do a 70-30 split of $13.2 million. 70% goes to the investors, 30% goes to me for managing the deal. Well, oh my God, well, how come you get 30%? Isn't that a lot of money? Well, yeah, you want me to do well. You want me to be able to drive the equity income value up and be able to get this sale price of $20 million. Like, that's my target for the last 5 years, to make sure that when we sell, we get a big score. That is my driving force. So yes, I should be compensated for that. On the back end, you're getting your preferred rate of return of 5%, which is what you're going to be getting on this transaction while we're holding it for each year, which, sorry, I didn't explain that part. So as you're investing into this property, there's going to be a preferred rate of return that you're going to get paid out to you every single month. Okay, 5 to 6% is guaranteed rate of return that you'll get paid out to. As like I said, the minimum investment is $100,000. If you, for all intents and purposes, you're going to get paid guaranteed 5% of your 100 grand every single year, right? You're going to earn $5,000 guaranteed income. That's going to be paid out to you every month. Now, maybe there might be some times where we won't be able to cash flow because we're value adding the property, but that interest is accruing. And if we miss a payment for the month, then we make up those payments as the money comes in, as it clears, and we're rehabbing. So you always get that 5% guaranteed rate of return, no matter what, for the year. Okay. Now, on the sale, let's go back to the sale of $20 million. We have the 70-30 split. 70% of that equity, which is 3.2 million, gets split between all the investors. Okay. 30% gets sent to me because I did a damn good job of executing and making you freaking wealthy. And I'm going to show you that right now. All right. So what does that look like? If you put $100,000 in, okay, look at it, think of it as a big pie. We're trying to raise $4.5 million. Okay, we raised $4.5 million. We have $4.5 million pie, and you put $100,000 in. You got a little slice of that pie. That little slice of the pie, we have to figure out what's your percentage of ownership of that $4.5 million. It's right here. It's 2.50% of ownership. So on that 70% of the 3.2 million, you're going to get 2.50% of $9.2 million. And what that number equates to, I'll highlight all of the calculations right here so you know that I'm not BSing you. Okay. Sale proceeds, this is the 70% of 13 million. It turns out to 9.2 million. That's your slice of the pie, 2.5% of $100,000. And 2.50% of 9.2 million is $231,000. $231,000 that you get out on the return, on the exit, okay? And all you did is put $100,000 in, all right? Now, but wait a minute. I'm gonna before you get all excited here, let me make sure we do the math properly so you know. You cash flowed for the last 5 years a preferred rate of return of $5,000 a year. For 5 years, 5 times 5 is 25. So you made $25,000 over the course of 5 years on your $100,000. Okay. When we exit the deal, before you get that split of 70%, I want to make sure that you get your $100,000 back. Boom, make you whole. Okay, you're whole now. You got your 100 grand back. Plus, you made your $25,000 back over the whole period. Okay, does your 401k pay you every month? No. Do they pay you quarter? Nope, they don't. They don't pay you nothing. You don't know. You don't get no cash, no checks in your hand at all. I'm gonna pay you every quarter, every month. Literally, depends on how we structure the deal, whether you get paid every quarter or every month. So we make you whole right here, $100,000. What is left over? So we just did the math. Okay. 231 plus your 25,000 minus your 100,000 is $156,000 that you are earning. Let's just do it. Let's just look at it a little differently, right? Let's just do 231 minus your 100,000, right? You're making $131,000 on the exit, plus your $25,000 while you were waiting for me to freaking be a rock star. All right. What does that mean on your cash on cash returns? You made 157% on your cash on cash returns. What's the average cash on cash return for the last 5 years? It's 31%. Double-digit returns. I don't know what other industry does the stocks give you. Stocks give you what, 9%, 8%, and you got to pay taxes on those gains. And if you take it out, you're paying those taxes. You're paying long-term, short-term gains tax, and you're paying the fees on top of that to even have your money in those accounts. Okay, we didn't even talk about the tax game. This $131,000 you're going to be able to share in the write-offs. Like I said, you're a limited owner, you're a passive investor in this partnership agreement because this asset's going to be owned by an entity and you're going to be a limited partner on this entity. So you're going to be part of this investment fund that's going to be a limited partner that's going to be tied to this entity that actually owns the asset. Wish I had a whiteboard, I can explain it. So that shared depreciation, those shared write-offs, you're going to get your 2.50% because you got your little slice of the pie of $100,000. You're going to get 2.50% of that, of those write-offs against that income. So you're essentially going to be able to offset most of your income. Now, on the cash out equity when we sell, all of that cash out, yes, you will have to pay taxes, or you could roll it into another deal. Or you can say, you know what, Rajesh? You're so amazing. You made me so much money. You made me more money than my 401k. Here's the money. Go invest into the next deal. And then we roll that money across into the next deal and you defer all those taxable gains. And this still continues to compound. We go do the next deal and that compounds and you get those checks sent to you every quarter, every month, whatever it is. So imagine if you had $200,000 or $300,000 in, those checks are going to be bigger. $5,000 is not a lot of money if 5% rate of returns guaranteed. But if you had $200,000 or $300,000, now we're talking about a little bit more, more money here. So let's just do the math. $300,000, right? Equals $300,000 times 5%. That's $15,000, right, per year. And we take that divided by 12. Is $1,250 extra every month that gets sent to you as a check if you put $300,000 into this deal. Okay, that's a $1,250 check sent to you every month. Or if you want to just do it by the quarter, take 15,000 divided by 4 quarters in the year, $3,750 every quarter, every 3-4 months, $3,750 gets sent to you. Boom, check. Okay, this is the beauty of real estate. So I just wanted to share this with you guys so that you can understand what I'm doing. If you have any other questions, DM me, send me a message. On my website, it's livefreecapital.com. That's LIV freecapital.com. Live, freecapital.com. You can check it out. I'm constantly updating it with blogs and FAQs and information there so that you guys can really wrap your brains around it. We're going to be looking to purchase about $20 million worth of real estate this year. If you want to be on board, you want to ride this wave with me, man, rock it out. Look, 31% average rate of return on your cash on cash, 150% rate of returns on your cash on the exit. It's double-digit returns. What other investment can possibly get you that much without the yo-yoing effect like the stocks? 1 minute it's up, 1 minute it's down, 1 minute it's up, 1 minute it's down. This is stable passive income. You can set this up for your kids and just leave it there and get those payouts every month or every quarter. Get those payouts and just boom, set it into a whole life, term life insurance or something, or put it into a FMLA investment account for the kids, or whatever. Because there's so many things you could do with this extra cash, but it's backed by real estate that's never going to go away. It's never going to disappear. It's going to always produce cash flow, and it's a stable investment. I hope this really serves you well, guys. Send me a message. Here to help you guys. We're here to get rich together. Look, I've been playing this game for 15 years now, really full time now for about 8 years. It's made me so much money, more than my job ever can possibly make me, more than I've ever made working in a job for the last 17 years. I made more money doing this in 3 years than what I made in the last 17 years in my job. I hope that makes sense to you. So you see the math right here. We're going to be investing. Send me a message. I'd love to have you on board and talk to you guys soon.